Good morning, ladies and gentlemen. Welcome to Invicta Holdings Limited's final results presentation for the year ended 31 March 2022. Stephen Joffe, CEO, is joined this morning by Nazli Raj Mohammed, CFO, and three of the executive directors, Tony Sinclair, Gavin Pelser, and Craig Barnard. Stephen and Nazli will be taking you through the presentation, and you will have the opportunity to post your questions by making use of the question function on your screen. I will post your questions after the conclusion of the presentation to the panelists. I now hand you over to Stephen Joffe.
Welcome to all of you, and thank you for joining us for the presentation of our results for the year ended 31 March 2022. My name is Stephen Joffe, and I am the Chief Executive Officer of Invicta Holdings. Our CFO, Nazli Raj Mohammed, joins me in presenting our financial results. During this presentation, to the extent we analyse information or make forward-looking statements, please have regards to our disclaimer. Today's presentation will cover our group and our new segment results for the year, and we will also specifically address the restructuring of Kiernan, the purchase of KMP, and other strategic focus areas. The operating environment, including adapting to various levels of COVID restrictions, the volatility in pricing and currencies, supply chain challenges, including shipping and logistics, civil unrest in South Africa in July, a NUMSA strike in October, load shedding and water supply disruptions, and lastly, we have a warehouse supplying automotive parts in Cherniv, Ukraine, which during March, Cherniv was occupied by Russian troops. Notwithstanding the challenging environment, we're extremely proud how our businesses performed during the year. The resilient character of our teams and the robust nature of our consumable parts businesses shone through. Notable items for the year include: we closed the Kiernan transaction, we disposed of the Samrin property, we acquired KMP in January this year, we concluded 1.5 billion rand in committed bank facilities. In our analysis, we increased sustainable headline profits attributable to ordinary shareholders by 34%. We generated 978 million rand cash from operations. As a result of our corporate actions over the past 2 years, we have reassessed our reporting segments. Our new segments are Replacement Parts, Services and Solutions, Earth-Moving Equipment, RPE. Replacement Parts, Services and Solutions, Industrial, RPI. Replacement Parts, Services and Solutions, Auto Agri, RPA. Capital Equipment and Related Parts and Services, CE. While Kiernan forms part of the RPE segment, we will report separately on Kiernan's business due to its relative size and contribution. When analysing our results, please have regards to our restructure of Kiernan. The business is reflected as discontinued in the statement of comprehensive income in the current period for 4 months, and for the entire year in the comparative period. As we maintain a 48.8% stake in Kiernan, its results are equity accounted and reflected as a joint venture for 8 months after the deal closed. In the statement of financial position, Kiernan is reflected as an investment in joint venture in the current year, while in the prior year it was shown as held for sale. The cash flow statement includes the full result of Kiernan in the prior period and for 4 months in the current period. Sustainable operating profit was 13% higher than the previous year. In determining sustainable operating profits, we made the following adjustments. We reversed a cumulative net profit of 63 million rand relating to the sale of our businesses and branches. This is mainly made up of 29 million from Kiernan and 38 million relating to our sale of BMG or industry branches to our broad-based economic empowerment partners. In determining 112 million rand sustainable net contribution from the Kiernan Group, the profit reflected as discontinued operations, which was the profit for the first 4 months, is added to the equity accounted profit, which was a profit for 8 months after the Kiernan deal was closed. We reversed the fair value gain of 400 million on the remeasurement of our stake in KKB and MIH. We added 17 million rand, reversing the fair value of options previously recognized relating to KKB and MIH. And lastly, we reversed 8 million rand, which is the amortization of the purchase price allocation assets. Making the appropriate adjustments last year, our sustainable headline earnings were 79 million rand. We are very pleased with the 42% improvement in sustainable headline earnings. As part of the restructuring transaction, Invicta was paid 28 million Singapore dollars, which was used to reduce debt. Making the same adjustments to headline earnings, the Invicta Group sustainable headline earnings increased by 34% to 379 million rand. There are a few additional items which we wish to point out. We impaired 14 million rand relating to a business we operate in Chernihiv, Ukraine. Since year-end, the Russian army has withdrawn from Chernihiv, and fortunately, our lease warehouse remains relatively unaffected. We've decided to relocate the warehouse to Lviv, Ukraine. We are also relocating inventory with the required government permission to Poland. The business remarkably has continued trading on a cash basis. KMP, which we will expand on later in this presentation, hardly made any contribution for the 3 months. This is mainly related to the first-time application of the group's accounting policies in the business. This business should make a 12.5% return on investment. Lastly, the Keenan deal was closed in August. Thus, the current period does not include the additional 23% of KKB's profit for the first 4 months, and we incurred 60 million rand tax on foreign dividends that was deal-related. Please have a look at our key indicators. Where appropriate, they've been adjusted for once-off items to present sustainable earnings. Operating profit was 13% higher than last year. In our analysis, our adjusted headline earnings per share increased by 34% to 351 cents per share. Our net asset value per share of 37.65 rand was 5.6% higher than last year. No adjustment has been made to the net asset value calculation.
Revenue was 15% higher than last year. While most of our business remained open during the various lockdowns, many of our customers were shut or partially open. We are currently trading in line with our pre-COVID-19 levels. Future lockdowns will affect this going forwards. The gross profit percentage at 31% was 1% lower than last year. The 1% was partly attributable to the sale of certain branches to our broad-based empowerment distributors, additional provisioning, and increased product and logistical costs. We are in the process of passing these costs on and restoring our margin. We remained focused on overheads during the period. Most of our businesses traded at levels where enhanced sales commission and bonuses were earned. This is a pleasing development as these payments help retain staff. We have already reviewed operating profit. Net finance cost decreased by 61 million rands as a result of debt settlement following strong cash generation. Profits from joint ventures is the contribution for 8 months of Keenan post the restructure. Our effective tax rate has reduced year-on-year due to Keenan now being treated as a joint venture. Included in discontinued operations last year was the capital equipment and parts businesses that we sold to CNH. Property, plant and equipment increased by 161 million. During the period under review, we spent 242 million on additions to property, plant and equipment. 79 million relates to replaced vehicles which were previously leased, mainly in the RPI segment. We acquired property in the RPE segment amounting to 42 million rands, and in CE we capitalized 53 million of inventory to our rental fleet which we lease to customers. Lastly, 59 million rands relates to the KMP acquisition. Our depreciation of property, plant and equipment amounts to 93 million rands. Investment in associates include our investment made during this period in BMG China, amounting to 37 million rands. Investment in joint ventures is our 48.8% investment in Keenan. This was reflected last year as an asset and a liability held for sale. Goodwill increased by 39 million rands. This is related to KMP. Other intangible assets increased by 27 million, of which 21 million relates to KMP. Finance lease receivables, including the current portion, reduced from 162 million to 84 million. 10 machines were recovered from a defaulting customer, amounting to 54 million, which partially explains the reductions. We have sold or rented the 10 machines and did not lose any money. As risk profiles change, management have been more cautious in advancing credit, hence the decrease. Loans receivable increased from 223 million to 285 million. We advanced 76 million rands to .com, and we are owed 37 million rands from the sale of the Samrand property. Loans to the broad-based empowerment partners increased by 39 million rands. The payment received from CNH of 103 million rands helped offset these outflows. We have remained focused on working capital. Inventories net of provisions increased by 421 million. 205 million, however, relates to KMP. Reducing inventories has been a major focus of management, who continue to focus on number of months stock held. Please see the breakdown per operating segment. Gross inventories increased by 445 million rands during the period. With COVID-19 affecting many of our suppliers, delays at the ports, approximately 10% inflation in our basket of products, and trading at levels higher than last year, inventory has increased. To prevent stockouts, we have made decisions to increase stock holdings. Our continued focus on ordering the correct inventory and selling aged inventory has helped to keep this number in check. Trade receivables include trade and other receivables. Trade receivables increased by 185 million rands. KMP contributed 81 million of this increase. We have seen across our companies that the debtor insurance levels are tightening. We continue to focus on giving appropriate credit and collecting our receivables. Please note our cash on hand of 582 million rands. Assets held for sale is a small property. During the year, 5.2 million ordinary shares were repurchased for 148 million rands. These shares, together with the 1.5 million treasury shares previously purchased, were cancelled, resulting in a reduction of ordinary share capital and share premium. After year-end, the group converted the ordinary par value shares into no par value shares. All reserves have been adjusted to remove the portions relating to the Keenan Group. Our interest-bearing liabilities includes borrowings and lease liabilities, which together amounted to 1.2 billion, of which 1 billion is non-current and 200 million is current. With our cash on hand of 582 million and our overdraft of 53 million, we have net cash on hand of 529 million. Our net interest-bearing debt is thus 670 million. The equivalent number in March 2021 was 760 million. This 90 million rand net debt reduction is after the 12.7 million pound purchase of KMP, the 75 million rand mezzanine loan to .com, 148 million rand repurchase of shares, and the $2.5 million investment in BMG China. It reflects good trading, disciplined capital expenditure, the closing of the Keenan deal, and sound working capital management. Please note that the 670 million rands exclude the IFRS 16 liabilities of 276 million. Including IFRS 16, net interest-bearing debt for the period decreased by 123 million. We have comfortably met our covenants at 31 March 2022. We were pleased to generate 978 million rands cash from operations. Last year, the disposal to CNH reduced working capital, which influenced the comparative. Please note the investment in subsidiaries and business of 268 million. This is primarily our investment in KMP. Please note the 297 million cash outflow on disposal of subsidiaries and businesses. This is mainly made up of proceeds received for Keen Ann of 437 million, less cash on hand of 720 million when the deal was concluded. Lastly, please note our net repayment of debt amounting to 338 million.
Operational segment review. Replacement parts, services and solutions, earth-moving equipment, RPE. This segment includes Keen Ann, ESP, KMP, amongst others. We will first report on the other parts businesses in the segment, and Keen Ann will be reported on separately. Our new business KMP forms part of the segment. Revenue, excluding KMP, increased by 11%. As a result of our first-time application of group accounting policies, KMP hardly made any contribution to operating profit. Notwithstanding this, operating profit increased by 22%. Net operating assets now include KMP and increased to 452 million. The return reduced from 34% to 15%. However, from April this year, we expect KMP to make a meaningful contribution to operating profit, helping to improve our return on operating assets. Please see how we determine sustainable operating profits for the purpose of determining our returns. The only adjustment made to operating profits was 2 million rand, which is the interest expense on the IFRS 16 liability. Earth-moving, which includes construction and mining, is 84% of our market. 16% of our market is derived from agricultural and forestry users. All our revenue in this segment is derived from the sale of parts. We are seeing good demand for our parts in all the markets we service. The good inventory levels at KMP will allow us to expand the business in the year ahead. Keen Ann is now reflected as a joint venture. From 1 August, following the acquisition, 100% of the results of KKB and MIH are included in the Keen Ann results. Invicta now owns 48.8% of Keen Ann. These results reflect the full Keen Ann group and not the Invicta ownership interest. The results are presented in Singapore dollars. Revenue was 111% higher than last year because of including the revenue of MIH and KKB. Operating profit increased to 24 million Singapore dollars, but due to the higher ownership interests in KKB and MIH, the prior year is not comparable. During the year, KKB did not perform as well as we had anticipated because of reduced gross profit. This is attributable to the higher input costs, especially that of steel and currency volatilities. We have since increased our selling price and the gross profit is being restored. Net operating assets, which includes net cash of 42 million Singapore dollars, increased because of the acquisitions, and our return on net assets was 12%. We anticipate our returns rising over the next year. Please see how we determine sustainable profits. The adjustment in the Keen Ann Group included the reversal of the fair value gain on the remeasurement of our stake in KKB and MIH, amounting to 37 million Singapore dollars. The addition of 1.6 million Singapore dollars relating to the put and call options previously recognized in KKB and MIH, and lastly, the addition of the amortization of the purchase price allocation asset and related tax amounting to 1.4 million Singapore dollars. Heavy machinery parts account for 85% of our sales, and automotive parts account for 15% of our sales. The biggest portion of our sales is to general traders, who then on-sell our products. Southeast Asia remains challenging, and our markets are all affected by the pandemic and related lockdowns. We are focused on increasing our return on investment with initiatives including refining stock holdings and restructuring of the business to improve the return. The sharp rise in steel prices and the shortage of vessels and containers are causing difficulties in the operating environment. In the 2023 year, our factories in China were shut for 3 weeks during the Shanghai COVID lockdown. Notwithstanding the lockdown, the KKB roller manufacturer in China and the distribution business in the United States continue to perform well. We are expanding our manufacturing capacities in China. Replacement Parts, Services and Solution Industrial, RPI, consists of 5 businesses and includes BMG. Revenue for RPI was 8% higher than last year. Sustainable operating profit was 1% higher than the previous year. The major change this year was with the lifting of COVID-related trade restrictions. All our employees were fully remunerated, and many earned performance bonuses. We regard this as a good outcome, as it helped motivate and retain staff. Working capital was well controlled, and operating assets reduced by 32 million rand, resulting in a small increase in our return. Please see how we determine sustainable operating profits for the purpose of determining our returns. The adjustments made to operating profits were 48 million rand, which is the interest expense on the IFRS 16 liability, and 38 million rand being the net profit on the sale of our branches to our broad-based empowerment partners. Consumables amounted to 60% of sales, and engineering, which includes value added to products, amounted to 40% of sales. Our businesses in Africa make up about 18% of this segment. Mining continues to be the biggest industry served by RPI, and we supply all types of mines, including gold, coal, platinum, chrome, copper, manganese, and diamond. Other than mining, we continue to serve a diverse range of customers. The unfortunate flooding in KZN impacted the start of the year. We are seeing projects in the processing and mining sector being given the go-ahead, and we continue to experience good demand from the agricultural sector. We will focus on serving our traditional markets, and we're constantly refining our product mix to create new markets. Some of these markets include renewables and food and beverage. We are seeing good opportunities in Africa, and we're excited with our prospects in China. While take-up in our online store has been slower than expected, it is gaining momentum. Maintaining our traditional margins will be an area of focus this year. Replacement Parts, Services and Solutions, Auto Agri, RPA. This segment includes our UPG businesses located in South Africa and Europe. Revenue for the RPA segment was 19% higher than last year. Sustainable operating profit was also 19% higher than the previous year. Please note, this is after providing 40 million rand for our Ukrainian assets. Net assets were also down as a result of this provision. Our return on net operating assets has increased from 28 to 35%. Please see how we determine sustainable operating profit for the purposes of determining our returns. The adjustments in the RPA segment include an adjustment of 3 million rand, which is the interest expense on the IFRS 16 liability. Consumables amounted to 98% of sales, and engineering, which includes value added to products, amounted to 2% of sales. Our businesses in South Africa make up 63% of the segment. Our businesses in Europe make up the balance. Automotive and transport are the biggest industries we serve in RPA, with agriculture also an important sector. Our European businesses continue to do well, notwithstanding the war in Ukraine. We are adding new product ranges, and we're seeing good demand from agricultural customers. Capital Equipment, CE. Our CE segment consists of 4 businesses, 2 being earth-moving related and 2 material handling businesses. Revenue for the CE segment was 17% higher than last year. Sustainable operating profit was 3% higher than the prior year. With the sale of our agricultural businesses last year, we have less profit to cover central overheads. As a result of good working capital management, our return on net assets has increased from 26% to 29%. Please see how we determine sustainable operating profits for the purpose of determining our returns. The adjustments in the CE segment included an adjustment of R1 million, which is the interest expense on the IFRS 16 liability. Earth-moving, which includes construction and mining, accounted for 79% of revenue, and material handling 21%. While parts, services and rental account for 34% of revenue, we can cover the cost of our operations based on those revenue streams. As customers extend the life of their machines, our part businesses continue to do well. Good mining activity continued this year, with good demand for big capital equipment. We are hopeful that the anticipated infrastructure spend will further assist our construction-facing businesses. Demand for electric forklifts is encouraging. Key developments and transactions. On the 1st of August, we closed the Keenan transaction. Keenan now owns 100% interest in MIH, the operations in the United States and Canada, and KKB in China, the leading non-OEM manufacturer of earth-moving rollers in the world. The 28 million Singapore dollars realized in the transaction was used to settle debt. As mentioned, our share of sustainable headline earnings has increased from 79 million rand to 112 million rand. On the 1st of January this year, we acquired KMP for £12.7 million. KMP has its head office and main distribution centre in Chelsea, England, and warehouses in Houston and Miami in the United States. The KMP brand is widely recognised and is a highly respected name in the aftermarket of capital equipment engine spare parts. In the 3 months since acquiring KMP, the business operations have exceeded our expectations. Looking forward, the group anticipates KMP will deliver a 12.5% return. Prospects and strategy. Invicta distributes world-leading, earth-moving, industrial, automotive and agricultural products, often exclusively, which are always available and are overlaid with a technical and service solution. We add value through our distribution chain, product availability, and providing technical support. Technical support helps prevent disintermediation and is a key part of our strategy to add value to our customers. We aim to grow a diversified, sustainable parts group, providing above-market returns to stakeholders. We constantly review and restructure our existing businesses to ensure they achieve the desired returns. We aim to have a geographical and sectorial diverse group within 4 years. Our objectives this year will include managing the supply chain challenges, managing working capital and optimizing operations, integrating KMP into the group, growing BMG China, looking for appropriate acquisitions. The world is in a precarious position. The zero-COVID strategy in China and the associated lockdowns will have a detrimental impact on the world supply chain. The war in Ukraine and its associated impacts on commodity and food prices will be felt worldwide. Rising inflation globally will result in borrowing costs increasing, thus creating more pressure on the consumer. With so much uncertainty in the world, we will continue to work hard on reducing our net debt position. When we think of net debt, we include the listed preference shares. Having a relatively debt-free business gives you time to respond to difficult situations and at the same time provides the capacity for us to implement our acquisition strategy should the opportunities arise. Our parts businesses are resilient and generate good cash, with many of the sectors that we serve performing very well. As a result of our relative financial strength, we are able to hold appropriate inventory levels to ensure that we continue to serve our clients without stockouts and delays. Accordingly, we are cautiously optimistic about the year ahead. We are extremely grateful that we've been able to deliver this performance in light of all the challenges that we faced this year. Thank you to our loyal suppliers, customers and advisors for your continued partnership with the group. Our incredible, experienced, diligent and dedicated team from the factory floors to the boardrooms. We thank you all for your efforts this year. Lastly, we wish to thank our chairman and the non-executives for their guidance and advice. Thank you all for being with us this morning.